I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario. With grab samples running as high as 32 grams per ton gold, a drill program will commence this spring to test the numerous targets located by recent groundwork. For more information, visit our website, rmroyalty.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome back to the show, Bob.
Yeah, Jim, good to be with you. It's always fascinating to review the markets, and here we are set for this week.
Such a fuss over a quarter-point increase in the Canadian Central Bank's interest rate, and I noticed the major banks didn't hesitate to raise their mortgage rates with it. What I want to know is, will they be speedy in increasing the amount of interest, the puny amount that they pay to us right now on our savings accounts?
Oh, right, yeah. Now, Jim, that's a bitter question. You're not supposed to ask that question. No, it's very slow to grind through the system, and they're very quick to increase rates. There's been debate about why the Bank of Canada would increase rates, but they hadn't increased for a long time. The U.S. had increased rates. But mainly, underneath it, market rates of interest, like 6-month Treasury bills in the States, have been rising for a long time. And we've found that in periods of financial drama, such as we're in now, that the history of the senior central bank making interest rate changes is usually 4 or 5 months after the same change was made in market rates of interest. And the idea that the central bank can really impose its will on interest rate markets is really rather naive, particularly when you're at a major change in interest rates. As we've been talking, we've had terrific rallies for low-grade bonds out of the crude oil disaster down to February of 2016, and the rebound was immense, and also narrowing of credit spreads as the concept of risk disappeared and went into the background. And this sort of is trying to peak in reverse here over the last 5 or 6 weeks. You got some technical excesses there in the move, and you've also had, let's call it an attempt to reverse the trend. And if it's done this month, like by reversing the trend, you had the extreme low in the credit spreads established a number of weeks ago. And then it came back and increased a bit, which is widening. And then it went back to test that low, and it didn't quite get there. And then now, this week, you're at a higher yield spread than a week ago. So it's attempting to change the trend, and we're watching it closely because the similar trend change with a breakout on widening credit spreads was seen in the middle of July of 2007. That was the last time you saw that. So, and we also look at the stock market and note that the margin outstanding grew to a record, which shows there's all kinds of speculation there. And the latest report, which is May, that's always a month behind, it was a downtick. So that's interesting as well. So, but in the meantime, and then also in the real high flying stocks, the FANGs and the favorite ones recently, early in June, the momentum on these was just fabulous. We were getting in our model, upside exhaustions as well as sequential sells. We did one on Microsoft and noted in that piece that we put out that there were some 130 other high-flying stocks making the same blow-off pattern. So, and just to back up one bit, this was we also figured that the stock market is as registered in London and in Europe could peak in around June window. And yeah, there's been some high flyers done that. It looks like London and it looks like Europe have done that. And then you have, that was based upon how great financial bubbles in the past have concluded in London and Europe. They're all usually, let's just say, centered around June. And then they turned around during the summer, and all of the great bubbles, going back to the first one, the South Sea bubble of 1720, that was the guiding model, and they crashed in the fall of the year. And so here we are, we're looking for something similar, a really good high. Now, when you're forecasting for a top in the market, there's a number of things involved with it. One is the possibility of the time window, which was June. Now, for that to work, you have to have a highly speculative thrust into June. And as we've been noting, that became measurable. There were excesses that were outstanding. So you've got that. So now you just wait for it to work over it. Now, since the U.S. market was big enough to be important in the 1870s, its pattern at the end of a great financial mania is to do the extra leg up into September, where Europe and London would have a sympathetic rally, but not to new highs. So we've given ourselves a fair amount of latitude here on how this great financial bubble will conclude. And make no doubt about it, Jim, that this is a great financial bubble, particularly when you include the action in global bond markets. You know, in Europe, German yield down to zero. Some places near-term deposits at a negative interest rate, which is, in a word, bizarre. But nonetheless, it still shows tremendous speculation. And one could step back and say, well, the central banks were buying bonds and were very instrumental in driving the rate down. So that we shouldn't confuse that and think that because it has an official seal of approval on it, that it is not speculative action. What it is the central bankers have become as speculative as any ranked speculator in history has ever been. So that's also going to be interesting. So there's a time when interest rates can go up and bond prices down. And most observers on that one would say this would occur with surging consumer price inflation and wage inflation. Well, I don't think we're going to get that. But also, if you look back in history on the great financial speculations, the collapse in a deflationary environment has raised interest rates. And the reason being is that as the boom goes away, so do earnings. Without earnings, you can't service debt. And then that gets through to governments as well, who rely on tax revenues to service their debt. So can interest rates go up in a deflationary contraction? Oh, they have in the past, and they will in the future.
We'll have more of Bob Hoye right after the break.
Lotus Ventures Inc. is a BC-based medical marijuana company poised to launch into the rapidly evolving cannabis sector. Lotus is in the final review stage of the Health Canada approvals to become a licensed producer, having arranged facility financing of up to $12 million, plus building permits for its prototype indoor production facility. Shares trade under the symbol J on the Canadian Securities Exchange. Visit our website at lotusventures.ca.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Bob Hoye. Bob, with the 0.25% interest rate hike by the Bank of Canada, some people have pointed to surveys where about a third of Canadians say if things cost them $130 more a month, they would be in distress. Does the central bank pay attention to what the little guy can put up with?
Oh, I think so. But, they're at a very grand station in the whole scheme of things. And there's a belief by policymakers that they really are effective and they have to do these things. And you're not in the room when they're making the decision to raise interest rates, but as I said earlier in the show, short-dated interest rates have been going up for more than a year. So the Bank of Canada followed. Are there signs of speculation? Yeah, you've got speculative stock market, speculative bond market, and you have a speculative real estate market. So, and interest rates typically go up in a speculative market. So the Bank of Canada has joined the crowd, which then prompted banks to raise all kinds of consumer loan levels and things like that, which is the way it works. So let's just stand back from whether it's the Bank of Canada or not and just say that in a boom, short-dated rates of interest go up. And then in a bust, they go down. Now, there is some cynicism with this increase by the Bank of Canada, is that should the financial markets become precarious, then they would step forward and from a level whereby they could cut rates. Now, I've seen it in the media, both in the U.S. and in Canada, that indeed this is what will happen. And if we go back to 2007, highly speculative market, and interest rates had risen to higher levels than now. And the street was saying, oh, don't worry about it because the Fed will cut interest rates. But they've never, that's a bogus theory. They've never looked at evidence. And the evidence is back to any number of 100 years you want to go back. On the business cycle, when the boom is on and people are active, interest rates go up. And then on the contraction, interest rates go down. So there's no cause and effect on interest rates. They just happen. So that was the thing to watch in 2007, latter part of the year, because the stock market peaked in October. And then into the new year, they're all saying, oh, you got to stay in because the Fed's going to cut rates. Well, market rates were collapsing. The T-bill rate went from 5% down to 0 while the crash was on. So don't anybody out there in the listening audience carry this idea, this very speculative idea that the Bank of Canada or the Fed lowering their administered rate will keep a boom going. Not at all. The contraction will happen, and with it will be declining short rates, such as treasury bill rates, and that will be followed by the senior central banks following down with their administered rates. Why these guys don't get embarrassed, I don't know. But anyways, it's going to be fascinating to watch.
We'll have more with Bob Hoye right after this. Plus, we have a question from the Netherlands that Bob will answer.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com.
Welcome back. We're chatting with Bob Hoye. Bob, we have a question from our good friend Willem Grooters in the Netherlands, and I always hope that I'm pronouncing it right. Most likely not. Anyway, our good buddy there across the ocean has asked, Mr. Hoye, are you still bullish on the U.S. dollar? I ask because I see one force that could propel the euro-U.S. dollar much higher to, say, 120, 130, perhaps even 140. A lot of U.S. companies have issued debt, borrowed money denominated in euros in the past few years. Now, Willem assumes it was done for two reasons, because they have such low interest rates in Europe, and the assumption that the euro versus the U.S. dollar would go much lower. People are shorting the euro in some cases with U.S. companies borrowing money, and he just wants to know, what the hell is this going to do to their financial situation?
Oh, well, you've got a good one there, and you must make a confession. We did have in the chart many months ago that it looked like we would do kind of a long, protracted saucer bottom, and trading either side of the 20-week exponential moving average, like in 2014. And so there was maybe 5 or 6 months that one could see that bottom established. Well, it didn't work this time. It just kept heading down. And although we felt that 96.5 was possible on the DX, it did go down there and slightly below. Now, a couple of weeks ago, we got another downside capitulation in the action, and so you think two of those is pretty severe forced selling. And it popped up a bit here, and now it's testing the low. Then we look at that perhaps commodities after the hit in earlier June could be kind of level to slightly better through July, maybe into August. So I'm not going to call a low in the dollar now, but at some point our overall long-term outlook will come into play, is that on the next contraction, suddenly the game will be to service debt in U.S. dollars into New York, and then that becomes quite the driving force on the pricing mechanism of the dollar. So that is somewhere ahead of us, and in the meantime, it's been a difficult game to follow, especially when our technical work has been so good at bottoms on this one. So patience, I guess, is required. But again, if the action in commodities, the industrial ones like crude oil and base metals, are going to be positive through into August, we're not going to have any rallies out of the U.S. dollar, and perhaps it may have to wait into September when there could be the first signs of a contraction appear, and that would show up in the firming dollar. It would also show up in silver doing very rapid drops relative to gold. And actually, earlier in the week, the gold-silver ratio did make a new high for the move, and it's backing off from there. But again, we watch that one because the gold-silver ratio, as we like to call it, is the metallic credit spread. And when it goes up, like it widens relative to gold, in the past has anticipated a credit crisis coming down the road, and that is likely to become visible later in September.
Bob, always fun chatting with you.
Jim, it was fun to be with you too, and we'll look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. If you have any questions for Bob or for the show, you can send them to info@housestreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of House Street Media Incorporated.